So 15 days, call it 3 trading weeks, since there's 5 days in a work week. But you miss that, and then boom, you're losing about 3.5% of your return per year over nearly a 30-year period.
Welcome to Retire Smarter with Kevin Kroski. Find answers to your toughest questions and get educated about the financial world. It's time to retire smarter.
This is Retire Smarter. Walter Storholt here alongside Kevin Kroski, President and Wealth Advisor at True Wealth Design, serving you throughout Northeast Ohio with offices in Akron and in Canfield as well. You can find us online by going to truewealthdesign.com. Listen to past episodes of the show and find out more about Kevin and the team, which, by the way, I do recommend going back and listening to our previous episode. Go back to episode number 40 and check that one out if you want to hear kind of, this isn't really a series, but it is sort of a part 1 and part 2 discussion of the fallout from the coronavirus pandemic. I guess they were pretty close at the time of our recording today, Kevin, of officially labeling that, so we might as well start going that direction and calling it that. But the issue of the coronavirus and the market impact that it's had and some of the other things that have been going on in the news. We talked a lot on the last episode about how you and your team have responded to that, how your clients and folks who are just everyday people like my dad are responding to that kind of issue. And we want to explore that a little bit more on today's show and go through a couple of different levels as we kind of look at the fallout from all of that and also just a current stock of what's going on. But the structure of our conversation, Kevin, it could be something other than coronavirus. It's still going to apply to today's conversation.
Frankly, we're going to spend most of the time talking about just the market in general and just how to respond and things not to do, quite frankly. And we'll set this up, the discussion in terms of looking at your portfolio and the asset allocation, and then we'll kind of go from there. But honestly, this is really timeless. There's always going to be some crisis du jour that's going to happen. Things have been fairly calm, quite frankly, for a number of years in the investment markets. That's not normal. More normal is more volatility. Academics, researchers that look at market history, they'll call it periods of time like this, like volatility clustering. So I guess imagine maybe like an EKG line, and you kind of go through and it's like a little beep and a beep and a beep, and you get the lines kind of spiking up. Did I say that right? EKG line?
Yeah, I think that's
you can tell I'm
correct.
a big, I should have been a doctor, right?
I'll ask Connie when she comes home later, since she works in the
thankfully,
in the
I'm a healthy
hospital as a nurse
43-year-old,
practitioner.
and I've had very little exposure besides working with a lot of physicians as clients.
I don't know if they call it the EKG line, but it is the EKG machine that makes the line. Yeah.
Okay. All right. So there's a lot of people, a lot of clients that are probably laughing at me right now, but
They're probably laughing at us. Yeah.
that's okay.
Connie's gonna be embarrassed when I tell her this conversation later. She's gonna say, "Oh, it's the this line" or something like that.
All right. So you're in the boat with me, Walter. But, so whenever the line spikes, that's kind of a volatility cluster, if you will. But what's happened really, I would say, post global financial crisis is certainly there was some aftershocks, if you will, from the global financial crisis of, 08 and 09. There was the Greek debt crisis, and there was kind of the debt ceiling issue that America had, and kind of Congress was creating in 2011, and it caused the U.S. to lose its AAA rating. There was a pretty big sell-off in that year. But in general, outside of that, it's been kind of smooth sailing. There hasn't been any amplitude. We've been down in the valley of volatility, if you will, but more recently it's peaked. And when things do get peaked like this and volatile, historically there tends to be a clustering effect, is kind of what I was alluding to earlier. So I certainly don't think that this is going to be over anytime soon. It's quite likely that the volatility is going to stay elevated for quite some time. And even after the coronavirus goes away, it wouldn't surprise me if something else comes back, because, again, these events do seem to cluster. But one of the things that, even before I kind of go into that, we've had a lot of clients that have we've kind of looked more recently at clients logging into their vaults. And we've had a lot of clients, logging in, and we've had a lot of conversations over the last couple of weeks, emails or phone calls and what have you. And we've got a lot of feedback that's saying, hey, seeing where my financial plan results are and that I'm still okay, certainly has helped me feel a lot better, and ignore and tune out some of the noise that's going on. Certainly our clients can log in, they can see their results, their investment results every single day. They have some benchmark comparisons, but importantly, they have their financial plan results right alongside of that as well to connect the investments to their lifestyle and their plan. And we've just gotten some really good feedback from that. So I'll just kind of make a quick, call it a public service announcement or a True Wealth service announcement, I guess. But, if you're listening, and you're a client and you haven't logged in and looked at that, please do, take a look at it. Certainly we review that when we get together, but we've just had a lot of clients tell us that, hey, that's been really helpful just to keep things in perspective and not really kind of get hung up on the daily gyrations that we've been going through. If you don't have that, or if you don't have a plan, that's a whole other issue. Certainly you need to have that, because just looking at the investments in a vacuum, not only does it not work or not work well, but at times like this, that's the only thing that you're looking at. So it probably makes you more susceptible to making a bad decision. And in light of bad decisions, what we're going to talk about next is market timing. So while we've had this volatility clustering recently, and I mentioned that the market historically is more volatile than what it has been of late, the last sell-off like we had like this was in December 2018. So it wasn't all that long ago in that regard. It did sell off from peak to trough about 20%. But when a 20% decline typically happens about once every 7 years. So here we are, basically about 15 months later and having it again. Perhaps that is kind of the volatility clustering that I mentioned. You can really only identify it in hindsight. However, even having a 10% decline, it happens about once a year, 15% decline about once, every 3 to 4 years. So, that's normal. I think what's really noticeable about this one is just the health scare that goes along with it. The whole global pandemic. I think we can use that P word now, Walter. I'll agree with you there. But what you really got to be cognizant of is, just resisting any sort of urge just to go ahead and sit on the sidelines, sell, go to cash, or do something extreme like that. It just doesn't work. And to go ahead and kind of walk through the evidence is why, let me back up and just kind of frame this in terms of asset allocation. So we've talked about this on past episodes, but the asset allocation, liken that to the recipe if you're in the kitchen cooking, and the ingredients that you have are the different mutual funds and what have you that you're combining in the portfolio. So both the ingredients and the recipe are important. You got to have good ingredients, right? You want them to be free range, organic, and all that good stuff. But what investment science shows is that the recipe or the allocation actually matters even more than the ingredients. So there's three, I'll call it two really broad types of asset allocation. And the third is really a hybrid. But you have strategic asset allocation where you're really just using kind of historical relationships of prices, of risk, and going ahead and combining that in a portfolio, just kind of really looking at the past, not making any future bets or expectations or forecasts or anything of the sort. It's really more kind of a buy and hold, or maybe like a buy, hold, and rebalance sort of approach. There's a firm just down the road from us in Akron, Ohio. We're somewhat friendly competitors. I think they've been in business since like 1990, but my understanding is, they haven't changed their portfolios in more than 30 years. So, I think that's a good starting point. Certainly you have to understand history. You have to understand how assets behave with one another to go ahead and try to smooth out the rides overall. We're not necessarily in that camp. On the other hand, you have tactical asset allocation. So this is using, economic forecast, price trends, maybe a coin flip, for crying out loud, to go ahead and make some sort of move into overweighting an asset, maybe even or country or sector, or maybe getting out and going to cash and then deciding to get back in at some later date. It's also called market timing. It's a very aggressive form of asset allocation. There's a lot of moves, generally speaking. And those are the two bookends. One kind of a buy and hold or buy and hold rebalance, and the other is a tactical approach, very, very active. At True Wealth, we're definitely more towards the strategic. However, I can frame it this way. So if you think of a runway, and you're flying in a plane and you're getting ready to land, and the captain turns on the seatbelt sign and tells you, hey, we're getting ready to land. And Walter, I don't know about you, but every time they do that, I look at my watch or figure out where we are, and we're like, we're still 20 minutes away. What the heck is he telling me this for already?
Well, why does it take so long to land the plane? Just get a mile from the airport and drop down, right?
Right. So you can tell I'm really high on the patience category as a personal trait.
We've definitely ruled out that neither of us would make a good doctor nor pilot.
Right.
Isoelectric line, by the way, I think is the official term for what the line is on the graph. Isoelectric, or more commonly just the showing you the waves or the waveform. It's like the P waves, and they all combine into the
that sounds pretty
ECG
close to what we
or
said.
EKG thing. Yeah, close enough.
So the you're getting ready to land, and I think why they do this is they just want to clean up the cabin or have you clean up the cabin, right? So you're doing that, and as you actually do get closer to the land, you can see the landing strip and where you're going to land. And the closer you get, obviously, it becomes larger, and it's closer to you. You can see it, what have you. It's always been the same size, but as you get closer to the runway, obviously it appears larger. And so when you think about making expectations about the future, whenever you are really on the runway of the financial markets, you're kind of day to day, week to week, you can't really separate noise from any sort of financial science. You can't, what the studies show, and I'll relay this here in a moment, is that it's just indistinguishable. There's a lot of noise. There's a lot of inherent volatility. There's no way to go ahead and be statistically reliable in any sort of forecast, whether it's using some sort of price trend or something like that. But as you kind of get a little bit more perspective, as you're a little bit higher up in the air and you're looking about a little bit longer term, say maybe 5 or 10 years, there are ways that you can go ahead and forecast future expected returns. There are ways that you can try to identify, if an asset is overvalued or undervalued. Now, if all this stuff is kind of, fairly close to the norm or to an average, then it probably doesn't tell you a whole lot. But if something, the more over or undervalued it gets from, say, maybe a historical average, or if you're looking at a kind of across assets, say comparing U.S. stocks to international stocks, for instance, then you can start having more confidence in some of these forecasts and some of these over or underweightings that you may do. And that's what we do at True Wealth. We call it dynamic asset allocation. It's definitely more strategic. We're not making big moves necessarily going in or out. We have a very defined framework that we follow, so it's clear for our clients, what they can expect from us. And having some of those guardrails in place also just helps to go ahead and just put guardrails on the portfolio, because ultimately that has to be matched back to the financial plan. So those are the three types. And again, it's really strategic and tactical, kind of a set and forget it, and a very hyperactive. And then there's all kinds of gradations in between, but we call it dynamic anyway, just to describe what we do. But we've gotten some calls recently from some clients. By and large, our clients seem to be very disciplined going through this. Again, I think, that's kind of our MO, plan first. You kind of prepare, you have all the different goals in their lifestyle and their financial plan ranked. We have a predetermined plan where if we do have to kind of pull back a little bit on spending, that we know where we're going to pull back from. So we kind of just beat this tomato stake into the ground, and repetition certainly helps and is warranted, particularly in times like these. However, you're always going to have, some people that are a little bit more concerned than others, and we got to be there for them, and we got to do our best to make sure that they don't kind of cause long-term financial harm by selling and going to cash and really just trying to get lucky rather than doing something that is going to be process-based. So we've had some of those calls recently, and I just did a little bit of work rather than just tell them stick with it. I just wanted to provide some context in addition to the reassurance of, hey, stick with it. And again, I think the financial plan is first and foremost. That's the most important thing. We've already looked at, when you're going to need the money. We know that none of the money that you're going to need tomorrow or the next year or the year after that or the year after that is going to come from the stocks. It's going to come from the more conservative part of your portfolio. You have plenty of time for stocks to go ahead and rebound. But beyond all that, and that's really important, but beyond that, when you look at the evidence, you just look at daily volatility. So again, we're kind of down on the runway. You can't really tell what's going on. I go back last week and I think there was like 2 down days of more than 3%, but then there were 2 up days of more than 4%. And Walter, I don't know about you, but I felt like a ping pong ball going back and forth.
Oh yeah, absolutely. Is this going to be the end of the volatility? Everybody's chilling out now. Oh, and then it's back down the next day with the slightest bit of different news. It just sends everybody off in different directions, it seems.
So when you look back on just say market history, say S&P 500, and it ran data from 1990 through the end of 2018, the S&P 500 returned about 9.3% annualized over that time period. However, if you just miss the 15 best days, and Walter, you may have seen data like this before, but this is kind of an open-ended guess type question here, Walter. So 9.3% annualized return S&P 500 if you just stayed invested all through the ups and downs. 1990s were really good. Tech bubble blew up, and you had the lost decade where the S&P 500 made no money. Through the 2000s, actually lost money for an entire 10-year period. And then the last 10 years, at least through the end of 2017 particularly, were all really, really good years. So all that being said, you had about a 9.3% return per annum. But if you just missed the 15 best days over that entire 28, 29-year period, what did your return fall to?
I'll just pick an easy thing and say half of that.
So not too far off, actually. It's 5.8%. So
a little better than half.
Yeah, you lost quite a bit. So you go from 9.3 down to 5.8%. So 15 days. Call it 3 trading weeks. Since there's 5 days in a work week. But you miss that, and then boom. You're losing about 3.5% of your return per year over nearly a 30-year period. And again, 3.5% may not sound like a lot. If you go ahead and compound that over a 30-year period, again, just doing kind of bonehead math and ignoring compounding, that's going to be something more than double your money by just missing the 15 days over that time period. So the point is, you don't know when the worst days are going to be. You don't know when the best days are going to be. I saw Peter Magellan, who used to be kind of the esteemed fund manager for Fidelity Magellan for a number of years, wrote something similar about this, about the best months and how he didn't believe in timing and trying to get in or out. Even though he was an active manager, he didn't believe in trying to time the market. He called it a fool's bet. So that daily volatility is certainly there. So that's there. Now from an evidentiary standpoint, I'm going to shift gears a little bit. So the volatility, yes, it's tough, but a much younger, maybe overconfident, higher testosterone Kevin Kroskey in grad school might be sitting in the back of his grad school finance class saying, yeah, but hey, what if you were able to go ahead and miss the worst days? Or what if you had a strategy that allowed you to go ahead and identify some of this stuff and, hey, maybe I'm smarter than the average bear and let's see what we can do. So I used to be overconfident like that, but maybe with the declining testosterone levels and a little bit more humility and life experience, I am certainly different these days than what I was back in grad school. And I'm just going to reference, there's a lot of different evidence that's out there. It's academic evidence, it's research, it's boring. But there was a study in 2014 that was done. And I'm not going to go ahead and name it unless I can bring it up real quick. But in short, what they did, or how these patterns, let me back up for a minute. A lot of times these timing strategies, so I mentioned like price trends or economic forecasts. A lot of it is kind of price trends. They'll go back and they'll look at the data, what happened over time, and hey, if I went ahead and when the 50-day moving average crossed over the 200-day moving average, I just got out of stocks, and then I would wait for it to go back, and then I would get back in, or they would look at things called like advanced decline lines or relative strength or all kinds of gobbledygook. So they're basically going back and data mining. And I'll use another way to kind of exemplify this data mining, maybe make it more relatable here. But Walter, I used to do this talk, and it was if you actually sorted all the companies in the S&P 500 that started with their company name, started with the letter P, what I found was the returns on those stocks were greater for the companies that started with the letter P over the companies that started with the letter M. It was in the data. So I found it. I said, hey, these companies with the letter P are doing better. I don't know why, but it's there. Now, hopefully you can detect the sarcasm and absurdity in my voice, but even though it's in the data, it has absolutely no bearing on what's going to happen in the future. You can go ahead and torture the data pretty much to do whatever you want if you beat it enough. But that's one example where it's in the data. You're going back and you're mining the data. There's no rational basis to believe that is going to produce higher returns going forward. It's absurd. And a lot of these sort of price trends and data mining exercises are fairly absurd as well. And they may have worked in the past. They may have, as long as you kind of missed some of the tech bubble and some of 2008, it looks on paper like you have a really good strategy. But again, there may not be any indication that is likely to work in the future. And so this paper in 2014, and maybe we'll link to it in the show notes. I don't have it at my fingertips, but basically what it did, it looked at most of the common, the really well-known timing strategies. And that's what, these are called, kind of momentum or timing strategies. And it said, well, what if I just go ahead and test this, not during the period where it looked really good, but we test it what's called out of sample. So test it in another time period, test it in another market, take it from, the US market over to Japan, or take it to the UK, or take it from, say, the period of 1990 through, say, 2010, when we had two big bubble bursts. Let's take it back to the 1960s or the 1950s or what have you. You're taking it out of sample, taking not the good period that you had where it looks like you got something. Let's take it out of sample and test it and see if we can replicate it. And basically what this researcher found was that, hey, this stuff sounds great. Who doesn't like a simple strategy that can go ahead and, get you out from catching a falling knife, preserve your capital, and then tell you when to get back in. But what they found is out of sample, it had all those strategies on average in aggregate had an 80% failure rate, 80% failure rate. So Walter, if you flip a coin, what's the probability you're going to get ahead?
Hey, I can do this one, 50%.
Right. And if you follow these very common market timing strategies that supposedly are going to go ahead and help you avoid catching the falling knife, they have an 80% failure rate. So I wrote a client communication recently. I said, okay, hey, let's get out of the ivory tower. Let's get out of the theory. Let's go to practice. And let's look at some mutual fund evidence. And Morningstar, who has classified mutual funds, benchmarked, and what have you for forever, it seems, they have a category. It's called their tactical asset allocation funds. And so all these funds state and behave as they're doing tactical asset allocation. They're getting in, they're getting out, they're using data. These are people with a lot of resources. This is their professional job, day to day. They went to some of the best schools. They have deep pockets. They have, you name it, they got it. And they're going out there and they're trying to use these strategies, these timing strategies, when to get in or when to get out of the market, to go ahead and have higher returns, better risk-adjusted returns. And so there's about 250 funds. There's exactly 250 funds as of the end of February of 2020 in this category. And one way to go ahead and compare these funds, say, to a strategy that's not doing that, that's staying invested through all the ups and downs, is just to look at risk. And so one way to consider risk, or said another way, I guess more exactly, is volatility, or how much, what's the wiggle factor? How much is it kind of moving up and down? And that tactical asset allocation category has similar volatility, similar risk to the Morningstar's category that has a stock allocation between 50 and 70%. So what we're going to do is compare the funds in that tactical asset allocation category just to the average return of the 50 to 70% stock category. And when we do that, what we see is over the last 3 years, again, this is ending February of 2020. Over the last 3 years, 78% of the tactical asset allocation funds did not do as well as the category average. I'm not cherry picking the best or the top 20%. I'm just picking the category average for the 50 to 70% stock. 78% failed to beat the category average. Over 5 years, 89% failed to beat the category average. Walter, what did we say the academic evidence found about these timing strategies?
Invest in companies that have the letter P.
Walter, Walter. Oh my gosh, Walter. Wrong. Thank you for playing. 80% failure rate, right?
Oh my gosh. That's why the old monkey can hit the dartboard mentality or phrase is out there, right?
Right. Broken clock is right twice a day, right, Walter?
That's right. There you go. Or 20% of the time.
80% failure rate. You look at the actual evidence of mutual funds, of professional managers that are doing this for a living with deep resources, and probably not uncoincidentally, their failure rate just compared to a similar risk benchmark, nothing great, just the average return for the category was 78% over 3 years and 89% over 5 years. So I suppose you can argue that the actual evidence is even worse because of what the data shows. And oh, by the way, while there's 250 funds in that category today, at least as of the end of February, there were more than 340 just in 2014. Walter, what do you think happened to those other 92 funds?
They're probably not around anymore, I would guess.
Why do you think they're not around?
They were so bad they couldn't even survive to today.
You're absolutely right. So what I represented is what the eggheads call survivorship bias. So, even though 78% failed over 3 years and 89% over 5 years, when you add in all the losers and correct for that survivorship bias, the numbers are even worse. So I think we need to just kind of, again, let's step back for a moment. Things are bad right now in the market as I record this on March 10th. The market last week was up more than 4% on 2 days, was down more than 3% on 2 days. For the week, it was actually slightly positive, but it was coming off a really bad week the week before. Monday, yesterday, was a terrible day in the market, sold off the most since the global financial crisis. Things are bad right now, but you're not going to be able to go ahead and time this stuff. The theoretical evidence is terrible for these more sophisticated strategies to go ahead and make timing decisions. The actual evidence from mutual fund managers that do this on a day in, day out basis, that are, they're smart people. I think they're a little bit wrong headed in what they're doing as the evidence shows, but they're smart people with a lot of resources, a lot more resources than you or your advisor down the road or whatever. And the results are terrible. So be humble. Don't go ahead and just panic out and sell to cash and go to cash just because it feels good. You are completely making a knee-jerk reaction, and maybe you get lucky, but for us, there's no reason to go ahead and invest your hard-earned money in any way that's going to be reliant upon luck for a good outcome. You need to stick to the plan. If you don't have a plan, you certainly need to get one. And then you have an investment process. We did a 4-part episode, I think it was last year, on our investment process. There's some additional things that we're doing right now in terms of, rebalancing, tax loss harvesting, things that we won't get into today. But we talked about what a prudent process looks like, talked about the process that we go through. We have the plan in place. We have the process in place. We stick to it. And this is really where we roll up our sleeves and get things done. Bonds have held up a lot better. Stocks have sold off. Interest rates are a lot lower today. So we can't expect much from them going forward. Certainly they can preserve some capital, but they're not going to get the returns our clients need. So we are thinking a little bit differently about our portfolios in light of the new information that's been dealt us over the last couple of weeks. There's also some other things going on in the market that people should be aware of. Some people over the last years have been reaching for yield. Interest rates are low. They've been loading up on things in like real estate or high yield bonds or other like bank loans, other credit sensitive investments. These are not really liquid investments, even if you own them in an ETF or mutual fund format. You're seeing big dislocations in the market. You really have to kind of, if you don't understand this stuff, hopefully your advisor does. I can tell you we spend a lot of time looking at these market dynamics and making sure that we're being very prudent in how we're allocating our client portfolios. But it all comes back down to that being prudent and having a process and sticking to it. Don't go ahead and capitulate. Don't go to cash. Don't make a knee-jerk reaction. The money that you need for your spending for tomorrow, for the next year, the year after that, is not in the stock market. And if it is, you're making a big mistake. I can tell you none of our clients' money that they need for the next few years is in the stock market. The money that they need for 5 or 10 or 20 years is in stocks, and they have plenty of time to go ahead and recover. But as seductive as these market timing strategies sound, I mean, who would not want to be in the market only when it's going up and be out when it's going down? I mean, Walter, I don't know about you, but I mean, if I could find somebody to do that, I'd be happy to close down my business and I would just give them my money because, I mean, you can't lose, right? But it just doesn't work. And it's easy to fall victim and to prey for unscrupulous people selling this stuff. But it's also easy for people to go ahead and fall victim to their own emotions and fear during times like these. And it's really our job as advisors, as leaders, to go ahead and show them why that's not a good decision. Show them that they're going to be okay. Show them that, hey, not only do we have a plan, but we are rolling up our sleeves and we're executing that plan right now to make sure that you're going to stay on track.
I'm still hung up on the investments with the letter P did so well. There's got to be a reason, Kevin. We need to dig into that further.
Walter,
find out why. It's like kids.
I've lost you.
Kids that get named with the letter A. You know what I'm saying? The kids that have they say name your kid with the letter A because they'll be called at first for things. They'll get to experience more in their schooling years. You know, there's kind of a rhyme or reason to that. You know, early in the alphabet kind of mentality. As a Walter, you know, I was always at the tail end of whatever process there was, whatever line there was.
Now I see why this is coming up. So this is
so
this is
the
really
P is like jumping out to me.
This is some deep-seated thing about Walter and him getting called last in class. I understand now.
That's right. That's right. There's some jealousy of letters in front of me. No, just messing around. But this is really helpful, Kevin. I think some of the stats that you've given on today's show they're definitely eye-opening to kind of hear that the case for why it's so dangerous to just to stock pick and everything related to that. You laid it out very well. And by the way, for listeners who are interested in hearing more about the process that you were discussing, Kevin, that begins in episode 27, our 4-part series on your investing process. Do you have an investing process? And lots of conversation about most people not understanding their advisor's process if they indeed have one in the first place. So it's definitely a great series to listen to, especially if you're new to the podcast. You're maybe looking for some episodes that have already been published that you can go and learn more about Kevin, learn more about the show, and get a good introduction to kind of what we talk about here each week. That'd be a great place to start. Go back to episode 27, and it's a 4-part series on the investing process. And we'll put a link in the show notes of today's episode where you can go and find those 4 episodes in case you're interested in checking those out. Well, Kevin, really appreciate the help and the guidance on today's show as well as the previous one as we kind of talk about coronavirus and timing and asset allocation and how you've responded over these last 2 episodes. It's been a lot of fun to get that information from you and hear how you view this whole thing. And, it may not be the last that we talk about it. Coming up later in April, we may come back around to this conversation depending on what continues to happen to the markets. So we'll keep an eye on that and look forward to your analysis and guidance as we kind of move through this definitely changed time period. No longer are we in that never-ending bull market. Now we've got kind of a new thing to analyze and talk about compared to the past couple of years. So more to keep our eye on, and we'll look forward to doing that with you again soon.
Yeah, Walter, let's end on a positive note, and I'll give you a question here so you can also finish on a positive note. So historical market returns for S&P 500 over time, what do those come in at? I know you know this one.
That's the 9% one, right?
Yeah, I have, it's not just S&P 500, but I have like total U.S. market here, 1926 through January 2020, about 9.6% per year. So, we've had a decline recently here of about 15%. Certain parts of the market are down more than 20. I don't believe the total market has reached a 20% decline yet, but whenever the markets sell off 10% and you look out a year later after that happens, the average return on the market on this research index is about 11%. If the market sells off 15%, it's around 9.1%. And if the market sells off 20%, the next 1-year return is about 14.2. So just keep that in perspective. Prices have gotten cheaper. In general, markets go up over time. They're just kind of permeated with the short-term declines that we're going through right now. But what's interesting about that as well is while the 9.6% is the historical average, all of those returns are not too dissimilar. We're talking about anywhere from 9 to 14%. So, it's difficult to predict. Just another way to go ahead and show that as far as the timing. So high returns are looking better. The market has discounted things. Stocks have gotten cheaper. That means forward-looking expectations look better now.
Well, it's so interesting to hear your analysis of these things, Kevin, each and every time we join, and can't wait for the next episode already. If in the meantime you have some questions for Kevin about something we've talked about on today's episode or a recent episode of Retire Smarter, we do encourage you to reach out. You can also schedule a 15-minute call with an experienced financial advisor on the True Wealth team by going to truewealthdesign.com and click on the Are We Right For You button. Again, go to truewealthdesign.com and click the Are We Right For You button to schedule your 15-minute call, or you can dial in directly at any time at 855-TWD-PLAN. That's 855-893-7526. For Kevin Kroskey, I'm Walter Storholt. We'll talk to you next time, right back here on Retire Smarter.
Information provided is for informational purposes only and does not constitute investment, tax, or legal advice. Information is obtained from sources that are deemed to be reliable, but their accurateness and completeness cannot be guaranteed. All performance reference is historical and not an indication of future results. Benchmark indices are hypothetical and do not include any investment fees.